All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show, brought to you by Madison Trading House. My name is Cyprian Francis, and with me, as always, co-founder, top guy, Mike Patton. How's it going, Mike? Good morning.
It's going great. How are you?
Happy July 6th. How was your 4th of July weekend, sir?
It was good. It was good. I just relaxed. I saw a few fireworks. Didn't really spend too much time on that, but just had a very relaxing holiday. Hopefully, everyone out there enjoyed themselves as well.
Other than the drama in Highland Park, let's
Yeah,
let's send out our condolences because I know
yeah,
that I knew a couple people that knew somebody and
yeah,
uh, definitely don't want to see that in the old neighborhood.
yep.
Um, so with that being said, today is Wednesday. The markets are buzz. There's a lot in the news. Where do we want to begin? Let's start over in China. It seems as if their lockdowns are continuing to enhance.
It's like a yo-yo. 1 minute it's down, next minute it's up. I mean, with China, we've discussed this, on and off for the last months, few months here. That 1 minute you have China locking down. They have their zero COVID policy, as they say. And then as soon as things start to calm down a bit, they relax the rules. And then, of course, the inevitable happens and you get another outbreak and then they tighten the rules again. So it's back and forth, back and forth. And what's bad about this, for those who are not familiar with this topic, is that China is the manufacturing hub of the world. I mean, the vast majority of manufacturing in the world is done through China. And that means that every time they shut down a city, they're literally shutting down production to the entire world. So if Chinese people were the main consumers by far of their own productivity, then it would be an issue, but it wouldn't be that big of an issue for the rest of the world. But since they are producing stuff for everybody else, then that presents a problem. So this continues to exacerbate the problems with supply chains. People not able to get parts. I mean, a friend of mine just put down a deposit for a Tesla, and I asked, I said, oh, cool. I know you like Tesla. It's like, yeah, we're about to move, so family want to get a new Tesla. It's like, oh, when is it going to be delivered? He said, oh, well, next year. It's like March, March of next year. I'm like, 9 months, man, and that's not abnormal. A lot of vehicles right now. Good luck getting them, anytime soon. So in short, that slows down commerce. That means that money's sitting waiting to purchase something that it can't purchase, and it just makes problems worse. So this is also, we should also note that the numbers of cities on lockdown apparently doubled over the last week in China. So they went to 11 cities. I guess before it was like five or something like that, or six. And these cities, by the way, represent over 14%. I believe it's 14.9% of the total GDP of China. So for those who don't know what that means, GDP is gross domestic product. It means the amount of stuff, goods, services that your country produces. So the higher your GDP numbers, the more productive your economy is, the more revenue that you would be generating, for commerce. And generally speaking, the better the lifestyles are, you have more stuff available to partake in. Well, since China mostly is an exporter of, they have GDP, but they mostly are exporting goods and services to other places. Um, if you have a 14, if over 50, over 14% of your GDP is tied into these cities that are locked down, and as that increases, I mean that's huge. I guess if you're uninitiated to this concept, let me just put it this way: if your company loses 14% of its production at any given time, that is a massive problem. You're going to have layoffs, you're going to have all sorts of problems, you're going to be losing money. Probably you're going to go from profitable to in debt. You're probably going to go from making money to losing money just by that. And that's, you don't even need that big of a jump for that to happen. So for China to lose roughly 15% of its GDP because of these lockdowns, for a time that they're in lockdown, that's crazy. So it's affecting oil prices too. I don't know if everyone's noticed, but oil prices have tumbled dramatically recently.
Yeah,
And
that's what I was gonna lead. I was gonna lead into that, in the sense that the supply, that's bad news for supply, but it seems like it's good news for oil because oil came under $100 a barrel, I think, for the first time in quite some time,
Right.
was the headline. And so I think that's helping the markets a bit. But how long is the oil going to stay there? Do you?
Well, that's the big question. So, I'll just to backtrack a little bit on the oil part. Prices, it helps us with prices, but it's one of those things where you're getting something that's good, but because of something else that's bad. So you're getting lower prices in oil, but you're not able to really capitalize on that because you can't produce the cars, you can't produce as much products because if the source of those products is slowed down or shut off, then all the lower prices in the world don't mean much to you because it's only good for what you already have. So it's good for the time being, but if the reason oil prices stay lower is because of that, that's bad for the long term. Is much worse for the long term than the prices of oil being higher. Um, so to connect the dots here, folks, in case anyone doesn't understand what's going on here, when China or any place shuts down production, so think about the pandemic. When the pandemic hit, people were lockdowns occurred all over the world. People weren't able to travel as much, go as many places, etc. So restaurants shut down, shops shut down, and that reduces GDP sharply, but it also reduces consumption of oil. Our modern economies are completely dependent upon energy. If we didn't have cheap, readily available energy, in the case of hydrocarbons for our modern world, the economies we have now cannot exist. I mean, the lights would not literally come on. I mean, we would not be able to do anything like we can now. So when you have any sort of disruptions in oil or the production of oil, it creates problems. So with China, it's not that we're experiencing a production issue. I mean, we already have production issues globally, but this is more of a demand issue. You have less demand because less things are being done. So just like oil prices were collapsed when the pandemic hit because everyone realized at the same time, man, demand's going to drop off a cliff for the time being. Well, right now with China locking down, and of course it's the most populous country in the world, then that makes for some problems. So oil demand is going down, and that's what's pushing prices down. Now, how long it will last? This is a big what if. Basically, it depends, in my opinion, mostly on COVID. As long as COVID keeps affecting China the way it is, and I don't see how it wouldn't, that does put downward pressure every time there's lockdowns, puts downward pressure on oil prices for that time. But oil prices, even with this in mind, they have come back to the same price range they were the last time something like this happened. So the last time we had the big rise in lockdowns in China, which was before June, we had oil prices dive down to the 90s per barrel, which is exactly where they are now. Last time I looked, they were at about 96. Let me see. They're at 97 right now. So 96 was the last level we were at today, and that puts that in perspective that the market's consistently going back to the same price range every time this happens. So we do see where the market sees the price as being fair if the demand slacks because China's locking down. But ultimately, when we go through this year, by the time we get to the end of this year, I'd be very shocked if we don't have oil prices consistently averaged above $100 a barrel. So I think this is just a temporary situation. The moment things calm down again, things will resume. I think China is looking at it like this, and whether they're right or wrong, we'll see. But I believe what they're doing is this: they feel like if we lock down for a month or a few weeks, stop the spread quickly, and I mean, they're aggressive, so they're mass testing, they're locking people in their homes. I mean, they're not playing. Then they reopen for a little bit, then they shut down for a little bit. I guess in their minds, if they can piece it together where they slow down for a bit and speed up for a bit, it's better to them, I guess, than just getting through the whole thing all at once. Whether or not that's the case, we'll find out. My guess is that probably this strategy is not going to work that well in the long term. I still don't think so because, in my opinion, it's better just to get it over with and move on, like most of the rest of the world has, rather than constantly trying to stop something that you really can't stop. So oil prices will still be under pressure, and we have some other stuff too. The U.S. and its allies are pushing to cap Russian oil prices. I'm probably sure you heard about that too.
Yeah, and another news point that I saw this morning is that China's buying more Russian oil, India's buying more Russian oil,
Yep.
and we're in this like, oh, we're still going to continue to sanction oil, so it's really becoming kind of a battle of the world powers when it comes down to who's going to have the most oil or oil at a decent rate. So
Yep.
we're definitely going to have to keep our eyes on that. Otherwise, I feel like much of the market is waiting for the FOMC meetings to come out this afternoon. And
Yep.
then we do have some pretty big numbers coming out the rest of the week that may set the tone for the rest of the market. Any thoughts on those?
Yeah, so the FOMC minutes come out this afternoon at 2 o'clock Eastern. So, for those who don't know, the minutes basically are notes that were taken from the last FOMC meeting. Now, of course, the FOMC meetings are done in private, so no one knows what the notes say. Well, no one's supposed to know until they're released. So, when they get released, we're going to see exactly what they had to say. And the market's going to take that and figure out what to do with it. Now, keep in mind that the FOMC currently is in a very touchy position because there's lots of changes going on. So you have the war in Ukraine, between Russia and Ukraine, but also that's basically a global conflict at this point. You've got the oil issues coming back and forth. They're trying to cap Russian oil and trying to get China and India to align against Russia, which is not working at all, and I doubt it will ever work. But you have all those things. So the FOMC has to figure out, okay, well, what's the next big policy move going to be? Because now they have to adjust to that too. So when we look at the minutes, I think they're much more critical these days than they've ever been because there's so many things that change from week to week, and now the market's trying to get a gauge for where the Fed is going to move next. Like, what's their next maneuver? What's their next objective? So that's going to come out at 1 o'clock, 2 o'clock Eastern. I don't have any expectations at all what they're going to say because things really are changing that fast. So, um, they may say that oil prices down is a good thing for now, but I'm sure they're going to have to point out that these disruptions in supply chains based upon what's happening in China can't be good. So we have to see what happens there. Jolt's job openings came in this morning better than expected, which is one of the better surprises we've seen recently. The markets, however, have not responded very positively to that. We still have, let's see, right now, markets are down about 0.22%. So nothing that crazy, but we're still under pressure. So obviously, we're waiting to see what the Fed's going to say. But the thing is, good news is not necessarily good news because every time things come out better than expected, that gives the Fed more leeway to continue to tighten interest rates. So that's not going to be positive for the markets. So therefore, that's the response we should expect. And we've got employment numbers coming out later this week, unemployment as well as non-farm employment change on Friday. I do think, again, the market's going to pay very close attention to this because it's obvious at this point that the Fed and many policymakers are looking to increase unemployment. Now, a lot of people may say, why would they want to do that? Well, they've been talking about that ever since the Trump era. They've been saying, hey, we don't want unemployment to be too low. So part of their policies, part of their objectives seem to hinge on maintaining unemployment at a certain level. I think around 5% is the number they always like. So there are too many people technically employed. But again, in my personal opinion, and the opinion of a lot of people, the employment numbers aren't really an accurate portrayal of the actual employment situation in the country because you have a lot of people who are not seeking to get employed, who are completely unemployed, some people living on the street. Homelessness is definitely much bigger and broader than I've ever seen in my lifetime. And we also have people who early retired. You have, for example, some of the airline people that were striking. They were basically say you can either, some of them retired for reasons related to COVID vaccines and things like that. But the point is, a lot of people have chosen early retirement versus doing whatever they're supposed to have to do. And that means that you have people that aren't working who could be working, but they don't show up in the unemployment stats because technically they're not unemployed. They're retired. So I think that the Fed's objectives of increasing unemployment, while it may seem logical to them now, I believe ultimately they're going to realize that probably that's not a good idea, but we'll see. So I think a lot of people are going to be watching that number as well because I'm sure the Fed's going to say something about that in their notes, and then they're going to watch the number on Friday to see what the number is, and then connect the dots and say, well, if the Fed said if this happens, they're going to do that. Then we have our strategy.
Yeah, and I've seen the minutes really move the market at times, so
Yeah.
I can definitely sense the hesitancy in not a lot of moves being made going into those meetings, and you know, we'll definitely see if Friday's jobs numbers moves the market. And like you said, good news could be bad news could be good news. It's always this weird battle, and that's what makes trading and investing so exciting. And so, before we continue on, I want to just give anybody that's watching or listening a chance to ask a question. What we'll do in the next segment here is run through a couple signals or a couple tickers that Mike has. Mike and the group have been looking at, and we'll analyze it using the Madison Trading House software, which is a beautiful combination of analysis tools, fundamental tools, and in this show we like to dissect it and go over the specifics. So if anyone has a specific question, feel free to drop it in the chat. I'm also going to add a link for anybody that wants to try the software for themselves for 7 days. It'll be in the chat as well, so feel free to sign up for that. We talked about one name last week that I believe we have an update on, and that is Spirit Airlines. I
Yep.
believe we discussed that there's a couple bidders out there. There might be a position to buy and hold and play the bidding situation. So what do you got on that there, Mike?
Okay, so Spirit Airlines symbol is SAVE, SAVE. So to update everyone, Spirit has been in a bidding war since the beginning of this year. So Frontier Airlines is looking to merge with them. The board of directors for Spirit are in favor of this decision of this move, but there's a question whether or not the shareholders are going to agree. Because remember, folks, that in order for any merger to pass, shareholders have to be willing to tender their shares, meaning offer their shares up to the deals. They have to agree to it. It's a vote. But what happened is JetBlue came into the picture after the Frontier deal started, and JetBlue started making offers themselves. So now you have two, Frontier and JetBlue, competing with each other to get Spirit Airlines. So as of right now, one of the biggest developments were we were expecting in our last podcast, we talked about that they were supposed to vote on at the end of June on whether or not they're going to go with the deal or not, and if they're going to go with the merger, which one. Well, now that week they actually postponed it, which is something I suspected might happen because the shareholders clearly were not on board yet. They weren't sold on the idea yet. So basically, the company realized that there was a chance. I think I think they were worried that the shareholders would just say no to the Frontier deal and want to do the JetBlue deal instead. So I think that's the reason why the board of directors of Spirit are stalling for time. They're trying to get everybody on board to what they want. Now, I'm not sure exactly why they're so set on the Frontier deal, but they are, the board of directors at least. But on the surface, looking at the numbers, I think for shareholders, they would have to favor the JetBlue deal because they would instantly get a premium on their shares that they could liquidate right away if they want, and then they'd be done with it, right? So we'll see what happens. But they postponed the meeting to July 8th. It was supposed to be June 30th, I believe was the date, or 29th, something like that. And then um, so that's going to be in 2 days. They're going to do it again, see if everyone agrees. And JetBlue extended their offer out to the 29th, which kind of suggests that JetBlue's expecting that this next meeting is going to be postponed as well. So I have my gut feeling is that it will be postponed again, or something will happen that's going to keep the process going. But ultimately, JetBlue extended their offer to the July 29th. Frontier doesn't. I doubt they're going to back out or change anything on their end, except to make their deal seem more attractive to kind of finish it out. So this is something, if you guys want to park some money and to save, as of right now, the stock is very stable. It's basically trading around $24 a share, and it's been that way for quite a while. So as long as this deal is still on the table, there is a possibility if they go with the JetBlue deal, you're going to immediately see a big jump in the price of the price per share, since JetBlue's offering in the 30s per share. But in the event that the Frontier deal goes through, nothing much changes. The stock is still going to be pretty much where it is. So this is a fairly low risk opportunity if you want to try to capture that potential merger, and your whole time would be only, weeks to maybe a month or two at the most. So the only thing you have to worry about is whether or not Spirit's price is able to stay up. I would say right now, since airlines have been generally been beat up over the months, and here's Spirit's chart, just so you can see what I mean. Like, it's pretty stable. It's not really changing that much. It did go down to a low in May, down to 1625. But for the most part, it has its ups and downs, but mostly, I believe, due to oil prices and things like that. So, in short, this is an airline that does well in the for people who want to save money. And right now, I think most people want to save money. So I doubt they're going to have a lack of business. A lot of other companies are probably going to lose business. I believe that's the main reason why JetBlue is trying to get them, because this will be a segment of the market they don't have exposure to yet. It will just make their business more stable. Whereas Frontier, they're already in the same space as Spirit, so I don't see much of a benefit other than them having more access to more markets and more locations.
Yeah, and we have a more in-depth analysis using the Madison Trading House software in a video. I just put it in the chat, so if anybody wants to get a full play-by-play of the position and the opportunity, Mike does a real good job. So feel free to go watch that. So we'll keep an eye on that at least through the end of July to see if it pans out. It's just an interesting approach to investing in stocks, right? The
Yep.
will they be bought out, right? Play. But there's always different opportunities and different ways to approach it. And that's the beauty of having a tool like Madison Trading House, because you can have different strategies, you can run scanners, you can find opportunities that fit your style. And so that's what we'll get into now. And I'm interested to know the two names that you chose today, because they seem to be very similar stocks. And we'll start with the first one, Rivian, ticker
Okay.
symbol RIVN. What's the play there?
Okay. So these are two of the stocks that some of the members had brought up, because today we saw a really sharp move in Rivian. RIVN is the symbol. Both of these companies are EV manufacturers, folks. So let's just pull up Rivian first. Electric vehicle EV manufacturers. Rivian makes a truck right now, a little pickup truck, and Lucid LCID. They produce a sedan. Now, here's the deal. I mean, they're in two different market spaces. They're in the EV vehicle space, but they've chosen a different focus. So Rivian's basically going after like the pickup guys. They're looking for the people who buy F-150s and things like that. The Ford truck, in case anyone doesn't know what a F-150 is. And then on the other side, you've got Lucid, which is focusing more as a direct competitor to companies like Tesla, where they have a sedan, etc. So both of these companies are in existence. Both of them are producing, but there've been a lot of problems along the way, and a lot of these new startups usually run into problems on the production side. They can't produce the number of vehicles. They have disruptions, and of course, having a business of this kind is very attractive at this point, because you have a lot of investors who are just itching to buy into any startup in the EV space.
The next
But
Tesla. The next Tesla.
Yeah, what's going to be the next Tesla? And this makes sense, folks. In case anyone's wondering, like, why would they be so hot on this? Think about it. If we went back over 100 years ago, when you had the first car companies, right? People were investing into them. Why? Because it was the next thing. And once Ford basically broke the mold and said, or well, I should say broke the mold, but they created the formula for mass production of vehicles, and it got mass adoption with the Model T. Well, then after that, everyone else floods in and does basically the same model, and you had GM and other companies basically come to being. So even if a company doesn't end up being like General Motors absorbed a lot of different other companies, Oldsmobile, etc., Chevrolet, they just absorbed all of them into the GM umbrella. Well, with these other companies that come out here, it's possible down the line, maybe Tesla decides they want to buy out one of them if they really become a good competitor, or maybe GM, or maybe Ford, because a lot of these more established companies, they've let Tesla basically build the model on how to create EV vehicles, improve the concept, and prove that the market's there. And then they just come in later and say, okay, well, we're going to produce ours too. So Ford has the Mach E, and GM has, I forgot, they had the Volt, but now I think they have some other vehicles too. But the point is, any manufacturer can make electric vehicles as long as they understand the concept. So if these other manufacturers build the brand loyalty and build a good product, then you can always find a buyer. So there's a lot of reason to invest into these companies at this point. So these two companies look like they're going to do well, and that's the one of the reasons I believe people are happy or to invest into them. So Rivian, their big plus was sorry, I just realized I didn't delete my other notes, but their big plus was they have a production increase of 72%. They're on track to produce 25,000 vehicles this year, according to their report. That's a good deal. That's a really good sign. That means that they're actually making some progress. So if we look at the chart, here's a 6 month view. I'm going to go to a longer term view of this. So this is looking at a more detailed view of the history of the company going back to November of last year, 2021. So this company has not been around for a long time as far as a publicly traded stock. So it had its run up at first late last year, and then since then it's been on decline, 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 decline to where we are now. So we could say that this is where the price has stabilized. You can clearly see that for months and months and months, we've basically been at the same price. For several months, for a few months at this point, roughly around $30. So we now can see that that's roughly the value point. Now, if we look at the metrics, let's be honest, the metrics do not look so good for Rivian. Currently, their fundamentals are poor. Currently, their valuation is high. Currently, their activity from institutions is not good. And technically, they're not so good either. But because of this news that their production is up, and because they're on track to produce 25,000 vehicles, as the year proceeds, we'll probably see improvements in these numbers. And once we do, that's where I would expect this stock to really start to rally. So the near term news is just people are kind of jumping on it right now. If I look at the inner circle view, we can see that money flow is actually positive. So, if money flow is positive, which means that on these metrics here, based on the number of shares and based on the number of trades, we're seeing net more buying than selling. If that's the case, and apparently it is, there's a momentum in terms of buying at the moment, which means that this institutional ownership, which is currently 62.82%, might actually change to a larger number when we get to the next reporting. So when institutions purchase, we don't get their information up front. They have to publish it to the SEC, which is required by law. And then once it's published to the SEC in a certain amount of time, we'll get it. So usually it'll take a week, sometimes shorter, but usually a week or more for that information to get out. So once we know who's buying right now, because we can see that buying is coming in, we can find out, at that time who's the big buyer. But I will point this out. If we look down here at the institutional numbers, right? This shading down here in bluish color, grayish blue color, this represents the accumulation of buying activity. In other words, it's showing positions being accumulated in the stock. And you can clearly see there's a clear pattern that it's been increasing. Now, recently we saw a slight decline of 2.51% fewer institutional buyers. We also see that we dropped in three of the top tens recently. But again, institutional investment is always dictated by what the company is able to do. And if the numbers are improving, if the production is improving, then that changes the whole picture. Now, sometimes institutions are just going to make a decision based on what they see right in front of them. Sometimes they're going to make their decisions based on what they believe is going to happen down the road. So you have long-term Tesla investors who, of course, now have realized a massive, monumental return on their long-term investment. I mean, people who were institutions that were parking money into Tesla 10 years ago, they finally see a massive return on their investment. But remember, folks, Tesla was not a profitable company for a very, very long time. I mean, they went most of that 10 years in the red, and they actually got deeper in the red at times as they did more investment, but eventually things turned around. So Rivian, we don't know yet, how good of a company they're going to be, but they've got a buzz. I've actually seen one of their vehicles in person on the street. It was apparently someone had bought it, so that's pretty impressive. And I think they're building the brand loyalty too. So this space, the pickup truck space, Tesla doesn't have a pickup right now. They have, the Cybertruck concept, but they don't have an actual pickup at the moment. And as far as I know, I mean, other than Hummer with their EV Hummer and maybe a couple other companies that do EVs. I think Chevy has an EV truck as well. But other than that, Rivian's kind of starting the norm on this. They're kind of building their brand off of the truck concept, and we'll see how it works out. So if I look at the fundamentals, there's not much to go by here. I mean, sales wise, they're not selling anything yet. They're going to, but they're not really at that point yet. But projections seem to be more positive than negative as far as what's going to happen. 2022 is definitely expected to be a loss, but 2023 is expected to be less of a loss. And again, this is the norm for companies like these. They're new. I mean, we literally can track Rivian back only like 7 months or so, right? So it's not or 8 months. So it's not a lot of time that this company's been on the playing field for stocks, but because we are seeing this interest in the company and we're seeing some projections higher. We have analyst targets from anywhere from average of 58 up to the highest is 130. The lowest estimate is 24. So this is the way we look at it, and this is the way I would recommend anyone looks at this. If this company doesn't do too well, the lowest target is 24 bucks. You're at 30 right now. So you got a $6 downside. Not small. It's a 20% decline, but if things go well, you've got close to a 100% upside. And the numbers right now suggest that they're actually doing better. Their production is up, etc. So if I'm going to make a investment into a company in this space, the company I'm going to be more likely to invest in is the one that shows the most growth potential with the lowest downside risk. Now, we don't know what's going to happen to any company, but my experience has been as long as the company is able to deliver vehicles, as long as they're able to make some headway, investors will keep putting money in. The only time investors walk away is when the company can't make any progress. And so far, Rivian has made progress. So, therefore, I would say this is an attractive investment for people to look at. If you're willing to park some money and hold it for a while, you're taking some risk for sure. But you got to take some risk in this space if you want to be part of those big potential returns later. Okay, so if you want to try to get the next Tesla, right now you can get it for under 30, like around 30 bucks.
Yeah, and I think I've seen one of these driving around too, and it looked impressive. And
It
I was
does.
just kind of browsing the website, and yeah, the points you make are very valid. And it's unfortunate that the Madison Trading House software is basically telling you red, 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 bad, bad, bad. But like, you can only go up from there, right? Like in theory, with a product as sophisticated as this, right?
Right.
Like this is a very difficult product to get off the ground in a few months.
But keep this in mind. The Madison platform is telling us exactly what it should. When you're looking for a profile, let me backtrack a little bit. There's two types of stocks. There's the stocks that are already they're already firing on all cylinders. They're established. They're doing well, and they're stocks that could be those. Okay. So when you're looking for the profile of a stock, this is what the software does really well. You can build profiles. And this is the profile of a stock that actually has potential because you're not seeing institutions, it's not a fire sale. They're not dumping all their shares and getting out and running for cover. They're just holding where they're at. That's a good sign because if institutions are afraid, they're afraid for a reason. They're not afraid. They're just holding what they got and they said, "Hey, we invested." And they mostly invested at prices higher than where we are now. The targets are still up, so we still have some good analyst targets. It's just a matter of whether or not the company can deliver on its promise. My personal opinion is this company shows a lot of promise. So therefore, this is one I would say we should look at. Now, let's compare this to Lucid. Lucid has some better numbers as far as what I can see. They have sales growth. They actually are selling products. Okay. Rivian's just getting in, but Lucid is also new too, but they're actually selling. But as you can see, Lucid's been around since uh, the middle of 2021. So they've had much more time, but they've also had a pretty big roller coaster too. So they had their big spike here. Most stocks were going up at the end of 2021. So that's nothing strange. Then everything kind of came down, stuck. Lucid's been stuck around the $15 to $20 mark for a while. Now, Lucid's up today because of the news from Rivian. Now, this is sort of logical because what the market's basically looking at is this: all these companies have supply chain concerns, all these companies have production concerns, all these companies have the same labor concerns. So it's not like, even though they're two different companies, they have two different types of vehicles. They're still in the EV space and they still have to deal with a lot of the same issues. So, in other words, when you think about EVs, folks, think of it like this: the number one most important thing about the electric vehicle is always the battery. That's it. Everything else is window dressing. You want the car, I mean, think an EV vehicle does allow you a lot of flexibility in design. Like you can have two trunks, one in the front, one in the back. The motors, not really that big of an issue. Electric motor technology is very advanced because we've been using them for over 100 years, right? So it's not like we have that problem. Batteries are also advanced too, but they have a lot more room, in my opinion. So the mechanical parts of the car, they're just mechanical. We just get better materials over time, lighter materials, things like that. But it's the battery technology. Tesla proved it. Tesla proved that the battery technology is where it's at. So as Lucid and Rivian are improving that technology, and the truth is, they don't necessarily have to depend on themselves. They can always source their batteries from somewhere else. They can literally buy them from Tesla if they need to. So, in short, with established companies making batteries that are good, you don't really have that much of a worry anymore on that end. You just basically try to advance the technology. So, in short, all it comes down to now is whether people want to buy your vehicle, whether you make a good marketing pitch, you got the right price point, right price point, the right design, the right look and feel, the right branding, then you can get some sales, right? But if you just, you have the right vehicle range, et cetera, if you're missing out on those, then you're going to have some problems. So Lucid has a better profile than Rivian does as of right now. The fundamentals are not so great because it's a new company. And again, new companies typically lose money. That's just the way it works. Very few companies walk onto the scene as a stock that are new and they're just making money right away. It's very unusual. I would say probably the only companies you can ever find that could do that would be insurance companies or stuff like that. Like if they already have a cash flow, they just walk into the scene, they're already making money. When you're dealing with manufacturing, it's a whole different world. You got to build the processes, you got to improve things, so you need investment. So in short, what I would expect here, we had our first this is actually an earnings report for Lucid. Was the first one that actually had a positive surprise. So this was on the 5th of May. They were expected to lose 30 cents a share. They only lost 5 cents. Not bad. That's some strong improvement. If I look at their fundamental, we can see sales growth is clearly accelerating up. I mean, we don't have much of a history. Again, these are new companies, so we don't have like, the years and quarters, dozens of quarters of data. We only have what they've done so far, but we can see a clear pattern of growth. Now, what we don't see is improving net income, which means that they are losing money. Even though their sales are up, they're still losing money, but they're showing improvement recently. So we had sales drop, sorry, net income dropping at first, now starting to improve. And this is what I call the Tesla pattern. Tesla looked like this as well, although it looked much worse. And it was years and years of existence of Tesla. So we would see a huge decline in net income for a while, and it starts to improve. I might be able to show this on this chart. Let me see. I don't know if it goes back far enough to show it. Yeah, so right there, you can barely see it, but right there, 2017, Tesla was losing money, and everyone was worried. Everyone was worried. And then all of a sudden, they start to make money again, or sorry, they start to improve the gap that was getting smaller, and then eventually they turn profitable, and then it accelerated rapidly. This is the pattern people are going to look for in Rivian and Lucid. They want to see this start to turn around and improve. And this is the case not just for these type of companies. It's also the case for social media companies like Snapchat, etc. All of them have that same pattern. They lose money, then they start to improve, and they keep improving till eventually, hopefully, they become profitable. So the moment any of these companies breaks into profitability, their share price goes up very rapidly because everyone realizes now they've turned a corner. They figured out how to make a net profit, and once they can, then that makes the company much more valuable. So analyst targets here, 32.20 is the mid level, the lowest $12. So that would be roughly a 30% decline in the price, whereas the highest target is 55. So again, you have a favorable reward to risk, $14 potential upside versus a $6 potential downside, assuming the analysts are right. Looking at the picture here, we are expecting continual improvement on earnings. They're not expected to make a profit in 2023, but they don't have to. As long as there's an improvement in the bottom line and it shows signs that will keep getting better, after a while, eventually, more and more investors will pile in. Their profit margins are improving rapidly as well. So we can see there was a pretty deep decline here in September 2021, but it's improved greatly. So as long as we keep seeing these improvements, we're great. We're doing well. And also remember, these companies tend to reinvest. So they're going to keep putting more money back into their company to help it build faster, which is a good thing because that's what Amazon did. Jeff Bezos was very wise to consistently reinvest into Amazon, convince the investors that it's worth it. Don't take the profits right now. Let's take the money and put it back into the company, make it bigger, better, and basically now Amazon investors have to be very, very happy because the shares are worth vastly more by far than they were in the past. And same thing for Tesla investors. So both of these companies look good. I would say Rivian, the stronger news point. This one probably will have greater potential growth as long as it keeps on this track. It will eventually get to the point where they have some profits or some revenues that they're bringing in, and that should help pull the company's value up. For Lucid, it's more established. So both these stocks look pretty good. I can't say one is necessarily better than the other. They have their pros and cons. I would say again, Rivian has the bigger profit potential, but Lucid is definitely more established and therefore has showed more signs of potential growth. So either of these could be good investments or both. I would definitely say both of these show some good signs. They're at good areas where we see stable prices in their shares, and we see very clear signs of potential growth and improvement. So that's what we want to see, and we just have to keep monitoring them to see how much better these numbers get over time.
Yeah, so we'll keep an eye. That's our EV play. I believe we also discussed Tesla in a specific video not too long ago. So feel free to
Right.
jump on to the YouTube channel and go see what the software is telling us about Tesla specifically. With that, moving on, Mike. I think this is maybe one of the cool features of Madison here is every week, right? We have economic data that hits the wires,
Hmm.
and you are telling me that the software has a tool that allows us to find stocks when that news hits?
Yes, that's right. So I went to under the font section, we have, scan, screener, heat map, and then we have the calendar. And what the calendar is, it's a listing of all upcoming events, stock specific. So anything like a dividend, earnings, or something along those lines, or like a stock split, these all show up. So for example, let's just look here. One on the 18th of July, I see SPL and I have the number two. That means that there's a stock split that's going to occur on that date, and there are two companies whose stocks are going to go through that. So if I click here, we're going to see that it's Google. Now, Google has two types of shares. I'm not going to get into the definitions of this, but this is one, this is the other, right? So both of these are Alphabet, Google. They're both the same company. Their prices are slightly different because the different types of shares have certain rights and privileges that others don't. But for the average person, you're probably going to spend more time on Google, Googl, rather than Goog. But anyway, so this is where we're at right now. So it's going to be a 20 for one, which basically means that you're going to get 20 shares for every one. Now, this is making sense because these companies' shares are so expensive. And in order for people to really actively trade them, you got to have a smaller price per share. So currently, Google still has the good fundamentals. We did mention this stock before. Still looks good. Still looks like a great opportunity. So I would definitely say, folks, keep an eye on these two. They should get much more active once they do the split. We have the. This is where the split actually. Let me correct something. This right here is when the split actually would be processed, and this will be the first day that it should trade after the split. So on the 16th, it should be processed and done, and then on the 18th, it'll start trading at a smaller share, but same stock, just smaller price per share. Now, we also have dividends, DIV. Dividends will be when a company's stock goes ex dividend, meaning that the dividend is paid out to everyone who's a shareholder of record for that time. And all a dividend is a profit distribution. So if you're interested in taking advantage of that, like there's certain stocks that usually are pretty attractive for this. Comcast, for example, Comcast is a cable company and it's very established. Or a JP Morgan, which of course is a bank. Gap is a clothing store. So you have different types of company dividends. Usually, companies that pay dividends are so established that they can't really reinvest all the money they've got that they're making because their growth objectives they can't grow but so much. JP Morgan is already very 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 big. Comcast is everywhere, so it's kind of hard to get into newer markets at a sharp pace like a newer company. So what they usually do instead is they redistribute the income as dividends and then they reinvest some of it into further improvements in their company and processes, etc. And then we also have EPS, earnings per share. These are earnings releases where the companies are going to release their earnings for the previous quarter to let everyone know how things are going. So we can always know exactly what companies are having earnings coming up. So we can see that we have earnings really starting to kick in July on the 12th. And then after that, we've got earnings coming out every day, going all the way through the month, all the way up until the 29th, with a huge amount of earnings being released towards the end of the month. This is what we call, guys, earning season. All earning season means is it's a time of the year where you have a lot of earnings reports concentrated. And these are S&P 500, by the way, stocks that I'm looking at. I have it set right there. So it's only looking at companies in that index. But if I go to switch it, I can go to all equities. I can go to all that are optionable. Let's say I have an option strategy that I use for dividends or earnings or something like or splits. I can go here and just look at optionable stocks. And notice these numbers increase dramatically because there are a lot more companies that are in that list. So now I've got 259 companies that are optionable that are having earnings on the 27th, which is a lot. Now the S&P, these are bigger indexes. This is a bigger index, so the companies in this index are bigger. I can go to the Nasdaq 100, which would be the bigger companies in the Nasdaq, and so forth. So I have the option of selecting all equities, which would mean that everything that's having earnings is going to show up here, but we can also be more selective. Now, this is a great feature because a lot of the calendars I've seen that show you upcoming earnings don't really give you a lot of ways to filter through them. This does. And notice that we also have our proprietary scoring system already visible. So that means that if I want to look for an S&P 500 company that's going into earnings this month and has a good score, I can just do that. I can just sort by the score and I can see, oh, okay, RJF or Raymond James looks good. It's going to sort in order, but either way, I'm looking at this and I can see which companies like Humana, Rollins, or I can look at companies that are not looking so great on earnings, maybe, on their score. Maybe they have lower numbers. But either way, I can easily find something that fits what I'm looking for. I can sort by volume, I can sort by price. Just makes it very easy for me to find exactly what I want, what type of companies I'm interested in, and then I can find out, if it's something that I want to try to take advantage of, if there's something happening in that earnings that are of interest to me, and then I can go from there. So, folks, this is a very, very easy way to find opportunities. And usually I'm looking at S&P 500. That's my primary, or I'll sometimes look at the S&P 100 or the NASDAQ 100. But all of these companies in S&P or NASDAQ 100, they're all optionable anyway. I do a lot of option strategies myself. And I can also look up ETFs. Now, ETFs are not going to give me much in terms of results because some ETFs pay dividends, but that's it. They don't have earnings. And usually they don't have splits very often either, but they do occasionally. So I can look at any ETF that's paying a dividend. Some do. A lot of people like dividend paying ETFs because they're a group of companies and they just take the dividends from all the companies in the group. So sometimes these can be pretty nice ways to generate some extra income by holding those positions through dividend and then getting out after. By the way, this one right here, I'm looking at the score. Looks like there's a lot of institutional buying going on for AGZ, iShares agency ETF. I don't know what it does. It's not a high volume, doesn't trade that often, but for whatever reason, looks like some buyers are coming in for it. And if I go back to where's the other one here? Vanguard. Here's another one. Looks like people, this was more active, 6.94 million shares. So I can even find which ETFs are being bought into. That's a good thing if you're trading through dividends because usually stocks drop or ETFs drop when dividends are paid. But if you find something that's bullish and has a strong buying interest, a lot of times those are going to recover right after the dividend. So you collect the dividend plus the share price goes right back up shortly thereafter. So not a bad deal.
Yeah, I love that feature. Thank you for the play-by-play. I feel like a lot of new traders, investors underestimate the power of an earnings report on a specific day, being able to move an entire market or an entire industry. Or
Right.
so having that information beforehand is very useful, and I love the ability to filter. And you're right, it does look a lot better than the economic calendars or the earnings calendars that I've seen. So yeah, very much looking forward to utilizing that feature. And if
Awesome.
anybody watching, listening is interested in test driving Madison for themselves, once again, there is a link in the chat. Click that, sign up. One of the reps will get in touch with you, give you a nice little walkthrough of how to set everything up, how to utilize the software, and hopefully this can be a tool to help traders, investors make better decisions and improve their overall performance. All right, Mike, with that, heading into the end of the show, any final words, any wise words, anything that is on your mind?
Biggest thing again is this FOMC this afternoon. I just want to see what they have to say, and then I'm going to particularly look at what they say about employment because I know that's a major part of their policy decisions right now. And then, of course, on Friday we'll watch what the numbers say on employment, and then from that we'll get a gauge of what to expect next, and we'll go from there.
Awesome. Appreciate that. If you guys watching, listening are enjoying the stream, feel free to hit that like, that subscribe, that follow button. We appreciate it. If you have any ticker symbols, any questions, feel free to drop it in the chat. Hit us in the DMs, and someone will get back to you. Otherwise, thank you everyone for tuning in, and we will catch you all next week.
Thanks, folks.